Welcome to this webinar. Today we will be talking about real estate investing. In specific, we will be talking about directly owned real estate. Before we get started, a word of disclaimer. This webinar is free of charge. You're not expected to be a client of Empower Financial, either now or in the future. The information provided here is not specific individual advice. Please consult your financial advisor or tax professional for your own specific situation. The information presented here draws on various sources from the internet. While we've tried our best to find accurate and up-to-date sources, we cannot guarantee the accuracy of all the information provided here. And any investment products or examples used here are only for illustration, not meant to be specific advice. With that out of the way, let's get started. The agenda for today, we'll start off with introduction, and then we'll go over nuts and bolts, which really will help us orient ourselves to the landscape of real estate investing. We will learn some terms and concepts that are commonly used in the investing world. And with that, we should be able to move on to underwriting, which really goes to the heart of the presentation, and it shows how everything comes together. We'll look at the factors that you need to consider while underwriting, and we'll make it more concrete by going over an example. And then we'll look at taxes. How do investments affect your taxes? How do they show up on your taxes? We'll look at that briefly before going on to the pros and cons of directly owned real estate, which should help you decide if this is for you or how do you want to kind of get into this, and then we'll wrap it up. All right, this webinar is brought to you by Empower Financial. We are an advice-only financial advisory, and what that means is we don't manage your assets, but we give you comprehensive financial planning advice on all aspects of personal finance, like investment advice, budgeting, cash flow, retirement planning, tax planning, estate planning, college education savings, pretty much the entire gamut of personal finance. I also am a real estate investor myself, and I have firsthand experience on the subject here. I've bought investment properties, evaluated several deals, and I'm deeply familiar with all aspects of today's topic, be it financing, rehab, underwriting. So this topic is close to my heart. As I said earlier, this is a second webinar in this three-part series. If you haven't watched the first part of the webinar, which basically deals with the basics of real estate investing as well as primary home buying, I highly encourage you to go and take a look at that episode before you proceed here further, because what we discuss here is directly built upon the basics. And after this, there will be another episode where we'll discuss passive real estate investing, but that's a topic for a later date. And in general, while we talk about the various types of assets and asset classes, we will hone in a little bit closely on multifamily, and I will share with you the reasons why. And I've tried to make this presentation accessible to all by keeping the information presented here at a very high level. And of course, if you have any specific questions, you can always reach out to us, and I'm happy to discuss it with you. With that, let's get started. So what exactly is real estate, directly owned real estate? Directly owned real estate is where your name is on the title, or the name of your entity, be an LLC or a corporation, that is on the title. And you have a direct stake in the real estate investment, and you're responsible for all aspects of the investment. So as a result, you have full control over the decisions involved, whether it's when to sell, how much capital to raise, how much money to put in, what type of rehab to be done. So all those decisions, you get to take those decisions based on your best judgment. And as a result, you're also fully exposed to the financial outcome of the investment. That means if there are losses or profits or any lawsuits, so you will be front and center of the investment. That is what directly owned real estate means. With that, let's start looking at some of the most commonly used terms and concepts in this world. The very first concept is net operating income. NOI is perhaps the most important concept to understand as you begin your real estate investing career. Simply defined as NOI for a property is calculated by subtracting all operating expenses, such as repairs, maintenance, property taxes, from its total revenue. It is a measure of an investment property's potential to be profitable. So, as an investor, you're always looking to increase the NOI, and this can be done either by increasing the revenue or reducing the expenses, or both. And you will see that many things in real estate investing really hinge on this factor of NOI. A lot of things depend on it, things like financing, exit. So this is a very critical number. So let's make it concrete with an example. Let's say you have a property that earns you in revenue 100,000 per year, and you spend 30,000 of that to keep the property in serviceable condition, which are operating expenses. So your NOI is 100 minus 30, which is 70,000. It's very important to note that NOI does not include mortgage payments. So hope this concept is clear. We'll keep coming back to this over and over throughout the presentation. Now you might be asking, okay, NOI is great, but NOI by itself is abstract, because you can be making an NOI of 70,000 on a property that you paid 1 million for, or you could have paid the 2 billion to purchase the property. Clearly, if you paid 1 million, it's much better because you're earning a higher NOI on your 1 million investment. So that brings us to this concept of cap rate. Cap rate is the ratio of NOI to the purchase price. In other words, it is basically NOI that is normalized by the purchase price of the property. It is expressed as percentage, and like NOI, cap rate does not include financing costs. And one more unique thing about cap rate is that it's mostly used while buying or selling the property, as it gives you a very quick indication of your potential return on the investment before financing considerations. So as a seller, you'll want a lower cap rate, and as a buyer, you want a higher cap rate. This becomes very clear when I walk you through this example. Let's say you buy a property for 600,000 and your NOI is 48,000. Then your cap rate is 48 over 600, which is 8%. So if you are a seller, you want that 600 to be higher because you want more for your sale. So let's say if it's $1 million, then your your cap rate will be 48 over 1 million, which is 4.8%, which is great for the seller. On the flip side, if you're a buyer, you want the denominator to be lower. So if it's 480,000 instead of 600,000, then your cap rate becomes 10%. So cap rate is mainly used in transaction, and it's very directly and closely related to NOI. Moving on, the next concept that we would like to understand is CapEx and OpEx. CapEx and OpEx are shorts for capital expenses and operational expenses. So CapEx is defined as new purchases or major improvements that extend the life and value of a property, such as adding a new unit, adding square footage, finishing the basement. So CapEx, one thing to remember is it always adds value to the property. On the other hand, we have OpEx, operational expenses, which are expenses you incur to keep the property in a serviceable condition. So OpEx is everything like maintenance and repairs and if something breaks down, and taxes and so on. One thing to remember is that it takes away from the bottom line of the property. It does not add value, but it's the money that you're paying to keep the property in a serviceable condition. So as an investor, you'll obviously want to keep the OpEx to minimum, and then you want to strategically invest in CapEx to add maximal value to the property. Moving on, let's look at what operating expense ratio, or OER, it's also called ER for short form, is. It's nothing but the cost of operating a piece of property compared to the income brought in by that property. In other words, OER is calculated by dividing all operating expenses by operating income. Clearly, the lower the number, the better it is for you, the investor, as you really want to keep the OpEx to a minimum. So let's walk through this example. If a property has a gross revenue, that is a total revenue of 100,000, and if you spend 30,000 of that in operating expenses, then your OER or ER is 30 over 100, or 30%. Obviously, you'll want to keep this number to a minimum. Depreciation. So before we get into the definition of depreciation, let's talk about some background here. Most businesses use equipment, machinery, vehicles, property, and all these have a finite life. So IRS lets you account for this loss of value of a property over time, loss of value of property and physical goods as well over a period of time. And IRS has determined that buildings are physical assets that lose value over time. So they allow us to depreciate, or they determine that the value lost is over 27.5 years for residential buildings. And in some cases, like commercial buildings, like industrial or office spaces, it's 39 years. So depreciation is nothing but making gradual deductions in the value of a real estate property over its serviceable life, which is 27.5 in residential real estate. As an example, let's say you purchase a property for $1 million. And of that, let's assume that the land value is $350,000 and the building value is $650,000. So depreciation is calculated as the depreciable value, which is the building. Only building depreciates, the land does not. 650 over 27.5, which is the lifespan of that building, it comes up to around 23.63 thousand per year. Depreciation is one of the major reasons why real estate investments is attractive, and we'll talk about this more closely as we go along. The next important concept is debt service coverage ratio. From part 1 of the series, we know that leverage or debt is very common in real estate. Debt for real estate investments usually differ from residential real estate that you buy to live in a property, your primary home, in a couple of ways. First, they're usually not guaranteed by the borrower, but only the collateral. If you are buying a primary home, your credit score and your financial standing matter a lot. In case of real estate investments, in many cases they matter, but in most cases they do not, because the lender is solely evaluating the property on its own merit. And a crucial part of that is NOI. So clearly you want the NOI to be higher so that you can borrow as much as you want. Let's go back to this concept of debt service coverage ratio. It is a metric that looks at a property's income compared to its debt obligations, which is the financing cost. For example, if a property has an NOI of 80,000 and your debt obligation or the mortgage payments that you make is 40,000, then the DSCR of this particular property is 2.0. Of course, the higher, the better. It indicates how much cushion you have to make mortgage payments. Let's say your NOI falls, either because the rents fall or there's vacancy, or like in the case of pandemic, where your tenants stop paying because they're going through a hardship, then you'll want that cushion. Let's say if this 80,000 drops to 60 or 70, you still are better off. But if you start off with a debt service ratio of 1, then if you don't have any cushion, if your NOI falls, then you'll have to pay out of pocket. So clearly you want the DSCR to be higher, and most lenders look for a minimum DSCR of 1.2 while making your loan. In other words, if you have an NOI of 120,000 on a property, then they will be comfortable lending you up to 100,000 in debt service and no more. So this is a very important concept again, and we'll see how this comes into play during the investment. The final thing is Proforma. Well, what is Proforma? It's a financial model of your business plan. It captures all the variables, like your assumptions, like rent growth, any other income that you account for, projected expenses, as well as the facts that you know at the time of purchase, like the purchase price and your debt service, the interest rate, the term of the loan. And it captures all this and creates a cash flow from the time of acquisition of the property to the proposed disposition of the property. And because it's a financial model, you can change variables like assumptions like, oh, what if my rent doesn't grow at 5%, but instead grows at 3%? You can change these variables and see how it affects your cash flow and if your investment makes sense. So let's look at this with an example of this spreadsheet right here. NOI, that was the first concept that we introduced. According to this, there is an effective gross income of 115,000, and then there is expenses of 40,000. If you take away the expenses from the income, you're left with around 75,000. That's your net operating income that you have from this property. Let's look at cap rate. Cap rate is NOI divided by the purchase price. So you have an NOI of 75,306, and then right at the top, you have a purchase price of 1,550,000. So it comes up to around 4.85. That's your going in cap rate as the buyer. And the next concept we'll look at is operating expense ratio. Well, your operating expenses is 40,279 according to this, and your total gross income is 115,000. So 40 over 115 is roughly 33 or 0.33. 33% is your operating expense ratio. Finally, the debt service ratio. If you have an NOI of 75,000 and then you have your debt service of 41,000, it's 41 over 75, which is 1.8. It's a pretty healthy debt service ratio, which means that you have a little room should the NI fall to make debt payments. Now, as you can see, the spreadsheet looks intimidating and complicated because it has everything on it. It's really a financial model for your business plan. So it's not only very important to have a comprehensive pro forma, but it's equally important to capture accurate estimates and numbers because this is where your due diligence as an investor or a buyer comes to light. Big investors who buy commercial buildings worth millions of dollars often pay for this data because they want to get this right. There are a lot of companies which collect market data on the vacancies, the current trends, the trends of the rent growth, what is the average earning of people in that area in a zip code. So big investors often pay for this data because they want to absolutely get these assumptions right. And this is a very critical tool, and we'll walk over an example in the underwriting. With that, let's look at asset classes. What are asset classes? Well, asset classes are just various types of assets that you can invest in. This list here is not meant to be comprehensive, but these are the most commonly encountered ones. So on the residential side, you have single family, condo, townhomes, some multifamily with 4 or less units are considered residential. And then on commercial, you have multifamily with 5 or more units. You have office, industrial, hotel, retail, self-storage, mobile homes. Again, this is not a comprehensive list. There might be more. And then you finally have land. Let's take a moment to talk about multifamily. We find that multifamily is a relatively safe and stable asset class to invest in. Why? That's because housing is one of the basic human needs along with food and clothing. Other asset classes tend to depend on business cycles or seasonality, market conditions. A great example is what's happening to office right now after the pandemic. There's a huge disruption in the office space, and it's likely that it's going to be changed forever the footprint of office is only going to go down, with remote working and hybrid working becoming very common. Another example is hotel. There's seasonality involved, and it depends on the location. Whereas multifamily tends to be rather stable. Yes, it does have ups and downs, but overall, because of the shortage in housing that we have today, it tends to be relatively safe and mostly in demand most of the time. So that's why we prefer and recommend multifamily over other asset classes when it comes to real estate investing. Now, let's look at how do you quantify returns on any investment that you make? Well, we went over this in part 1, but let's quickly refresh our memories here. There are a few different ways, but these are the most commonly used ones. Let's start with the first one, equity multiple. Equity multiple does not consider time value of money. Let's say you put in 100,000 and you get back 200,000, your equity multiple is 2x. It's twice your return was twice the amount of money you invested. And it doesn't matter whether you got that 2x in 1 year, 3 years, or 5 years. So it's used for certain types of investment, and we'll see that. The next one is internal rate of return. This one factors the time value of money. So not only does it matter how much you get back, it also takes into account when you get back this money. It's expressed in percentage, and you need a spreadsheet to calculate the IRR. A less cryptic form of IRR is cash on cash. This also takes in time value of money, but it looks at it the whole year. For example, if you put in 100,000 and in the first year you get back 12,000, your cash on cash is 12%. It's a little less cryptic, and it doesn't matter whether you earn that 12,000 in January of the year, or June, or December. Whereas for IRR, it does matter. So cash on cash is more commonly used because it's easier to calculate and it's easier to kind of wrap your head around, whereas IRR is also used. And it's really important to note that all these are after the expenses and fees. It's what you as an investor get at the end of the day. With that, let's look at some of the investing strategies. Remember from our first part of the webinar where we said real estate investing involves a strategy. Hope is not a strategy. You have to maximize the value of a property to realize any gain. Again, these are not comprehensive. They are broad descriptions of the landscape. And all investment strategies are about adding value. And here are different ways to add value to realize gain. The first one is a flip. It's a short-term investment where an investor goes in, buys a property, fixes it up, turns around, and sells it. These are very common with small investors and single-family homes. Clearly, there's an addition of value because you are renovating the building and you're charging money for that, charging a premium for that. Equity multiple is a great metric used here because there's no cash flow. Usually, they take empty buildings, they completely rehab it and sell it. So if you start off with 150,000 and then you get like 250,000, then it's easy to, when you sell it, then your equity multiple is a straightforward metric to calculate here. There's another strategy called value add, and these tend to have longer hold times. They do involve rehab, but strategically, sometimes it's just the interior of the building. Maybe the kitchen is outdated, so they go in, they put granite countertops, they put steel appliances, so on. So they strategically invest in rehab, and they raise rents over time. And they also streamline operations to reduce costs. And when you do this over time and there is cash flow, something like an IRR is a great tool to use for value add. The next one is ground up construction. It involves acquisition of land, entitlement, and construction. It's a specialized niche. It has its own lending niche, like construction loans, and it's considered high risk. Why? Because you are engaging with the city building departments. you're doing environmental studies, all that is considered high risk because there can be delays, there can be, the city can turn around and say like, okay, you need to do this, you need to add these units, or you can't do this density is not approved. So there can be a lot of issues that you might encounter. So it's considered high risk, and it's a specialized niche where operators who've done it for a long while are comfortable taking it on. The last one is vacation or furnished rental. The value add here comes from catering to a niche audience who are willing to pay higher for convenience of, they don't need to open utility accounts. It's all furnished. So they go there and stay for a month or 3 months or a week. And because it's all set up for them, they're willing to pay a much higher rent for that. And you, as an investor, your value add comes because you're catering to these people and making sure that they are comfortable and willing to pay a higher amount. So these are some of the ways in which you can add value. And remember, you as an investor, your work is always in trying to add value and increasing that NOI. With that, let's move on to the heart of the presentation, underwriting. We've introduced a lot of terms and concepts so far, and now we'll see how all of this comes together. Again, we'll be talking specifically about multifamily, but the concept should generally apply to most of the investments that we've discussed so far. Well, underwriting is the process of evaluating deals and coming up with a financial model for an investment. It's an art as much as it is a science. So experience really matters. The more you do it, the more comfortable you are, the more you understand the business of real estate investing, all the variables that go in, the better you get at. Sound underwriting is very critical to an investment. It increases your chances of success. It depends on a variety of factors like income, expenses, financing, investment strategy, market conditions, and so on. And really, the best way to learn how to do this is start doing it. There are many templates out there for Proformas online. Grab one of them and start evaluating deals. Go on loopnet.com, which is like a Redfin for commercial real estate, or go to Redfin, look at deals, start plugging in numbers, and get your hands dirty. Try to understand what goes into underwriting. And then once you do that a few times, you can start running it by people who have more experience or an investor and getting feedback on how to do this. With that, let's take a much closer look into what goes into underwriting. I've put in 4 buckets here: income, expenses, financing, and strategy. This is just to kind of wrap your head around it. So let's look at it. Under income, we have current rents. Obviously, what is it earning right now? What is the potential, rent growth potential? What is the vacancy rate? Are there any sources of miscellaneous income like a laundry income, parking income, or utilities? So all the factors that deal with income go into one bucket. You have to have a solid grip on that. The next thing is expenses. There are operational expenses that we spoke about, leaks and HVAC system busting and so on and so forth that you have to attend to. So you can take in a contractor, you can assess the current state of the building, you can compare it to similar buildings, and more experience, the more easy it is for you to understand what to expect in terms of expenses, and also the growth rate of expenses due to inflation year after year. And then there are fees like legal, accounting, marketing, management. There's so many types of fees, taxes. So you have to have a solid grip on what goes into the expenses bucket. The next thing is financing. What type of loan are you going to go for? Is it a bridge loan or a conventional loan? What are the loan terms, like the rate and the term? Is it amortizing or interest only? Are there any penalties? And then there's capital expenses. So if you plan to acquire the property and then start doing some rehab, how are you going to pay for that? Are you going to pay? Are you going to take another loan for it? Or do you have cash set aside to pay for rehab? All this comes under the financing category. And then there's your strategy. How long are you going to hold it for? How quickly are you going to do the rehab? What exactly is the rehab that you're going to do? What are your plans for exit? Are you going to put it on the market? Are you going to kind of take more loan and kind of continue to operate it? What are the market conditions going to be like when you want to sell it? All these, again, it's as much an art as it's science, because some of these are guesses, and you have to really have a sense of how you're going to play this investment out for the next 2, 3, 4, 5 years, depending on your hold time. So all these are factors to consider, and let's make it more concrete with an example. Before we jump right into this example, I want to say how this all comes together. So you as an investor evaluate a deal. You look at it, you look at the advertisement, you look at like the listing, and you say like, okay, this looks interesting because it has these things going for it. You do some kind of basic underwriting to see if even it makes sense to make an offer. And then you contact the broker, you get some literature about the property. And this is called the investment prospectus, or a brochure, or an operating memorandum. I've put up one on the screen. You can see that. Once you get that, you have a little better sense of what this property potential is. So you do a little more kind of, you straighten up your numbers a little more, and then you finally make an offer. And if the offer is accepted, you put down a refundable deposit with a contingency period of 30 or 45 days or 60 days, depending on the market, depending on what your comfort is. At this point, your due diligence period starts. What that means is you get to go inspect the property. You can take a contractor, you can take an environmental engineer, you can do what you want to make sure that this potential property is going to be profitable and it's a viable venture to get into. So this is the due diligence period, and over here, your main job is to dig deep into the potential and come up with a viable financial model. So let's walk through that example right now. So this property, it's 7 units. There's some information given, and they say some highlights, like apparently it's 6 out of the 7 units have already been completely renovated, presumably by an investor who already did this. They've put in new AC units, dishwashers, washer air hookups, new windows. They've changed the plumbing and electrical, and it's a new roof. So it looks like somebody's actually gone ahead and done a ton of value add, and they're trying to sell this. Now, there's configuration of 6 2-bedroom units, 1 3-bed, and then they say it's a perfect opportunity for exchange buyer looking for a very low maintenance and high cash flow. This is what they claim, right? And this might be on the right off the bat, it seems like it's for somebody who doesn't want to do too much work, somebody who likes a well renovated, maintained property, so they can just coast with rent growths and appreciation. It looks like they're targeting that type of investor base. And each broker for a seller puts out a financial analysis like this, what you're seeing on the screen. This might look intimidating, but it's trying to capture all the financial data about the property. On the top left, you have some basic data about the property, like what is the cost per unit, when was it built, and so on, the purchase price. And they're proposing a down payment of 1.1 million. You don't have to stick to this, but they're proposing that if you take 1.1 million in, put down 1.1 million and take 1.2 million in loan, this is what the financial picture would look like. They're giving a proposed financing. Apparently, the seller is willing to finance the property for up to 10 years, according to this. And then they put out annualized expenses, like taxes, maintenance, insurance, utilities, landscaping, property management. A word of caution here. This is the seller saying, or the seller's broker saying, this is what the financial picture of this property looks like. You have to take it with a grain of salt, because it's in their best interest to put lowball some of these numbers like expenses. And that's where, if you have experience, or an experienced investor will be able to say, okay, property management of 5% looks great, that's about the standard, but maintenance of 4,500 for the entire year for 7 units, that doesn't look right. So you can go ahead and tweak these numbers. Note this is a starting point, but you are responsible for all the due diligence that you do. Likewise, they've given some current rents, and they've also said that like these current rents are below the market, and you can really go up to the market rents. Obviously, they don't say what it takes to raise current rents from rents from the current to the market. Obviously, there'll be some work. There might be rent controls. So there's many factors there. Again, it's your headache as an investor to kind of delve into why the rents are lower than what the market can command. So this is what they put out, and our job as an investor is to take all this, site visits, and going there with a contractor, talking to the county about maybe if you want to do some addition. So all this needs to be represented in a Proforma, what we just saw. I just made up a Proforma for this investment opportunity. It's not something that I spent hours on. I spent 10 minutes literally, because I have some sense of what expenses look like. So straight away, if you're looking closely at the Proforma, you see that the operating expenses I have here for this property are closer to 55,000 per year, as against the 50,000 that they have claimed in their operating memorandum. Why? Because I think that they have lowballed some of the items. So likewise, and you might not go with the seller financing, you might go with a different financing. So everything that we spoke about, if you look at the column here, it has these growth estimates. What are the rent growth estimates? What are the expense growth estimates? And what are the current values for these? So you as an investor need to fill out this Proforma sheet to the best of your ability. And then once you have that, once you plug it in, you'll see, okay, the cash flow is 69,000 per year after debt service. That is what you get in your bank for an investment of 1.142 million. Does it make sense? Well, you have to answer that question for yourself. You'll see the rent, the growth in the cash flow over time. So basically, your Proforma will tell you if this investment makes sense or not. You commonly hear the term, the numbers don't make sense. And this is what it refers to. If you see that you're getting 2% or 3%, you're better off probably putting your money in a CD or a money market right now. But you might have other reasons to consider investment, but just saying that numbers need to make sense for you to proceed. At the end of this, once you have these numbers, once you're comfortable with this, once you feel like you've put in accurate numbers, you decide to either close the property, go ahead and apply for that loan, get that loan, and close the property, or you'll back out and get back a refund and move on to evaluating your next deal. So that's how this works. This spreadsheet can look intimidating, but there are many, many out there. Templates, if you just search for real estate Proforma templates, you'll find many, and you can take a look at a few and just get familiar with the whole idea of how to fill this Proforma templates. Again, it's very important that it's comprehensive and the numbers are accurate, because your business plan hinges on this. All right, we've spoken a lot about underwriting and okay, now you've made your investment. What does it mean for your taxes? How does it look on your taxes? Let's talk about this a little bit. The benefits of directly owned real estate. Tax benefits come primarily in 3 different ways. First one is conversion of your regular income to capital gains. Why is that important? Because regular income tax is higher, the rate at which regular income is taxed versus capital gains. So it's obviously favorable to have capital gains income rather than regular income. And real estate does a great job of moving your income to capital gains. How does it do it? Firstly, all operational expenses they reduce your taxable income. The next thing is depreciation. It's a phantom expense. Remember that you're deducting the value of a property over its lifespan. It's not something that you're paying out of pocket. It's a paper expense or a phantom expense. That also reduces your operating income. Sorry, it reduces your taxable income. The next thing is any improvements that you make, like you add a new kitchen or a new unit, that adds to the value of the property, but also that trickles down into depreciation, because that has a finite life. You can start depreciating that as well. So we'll see this first bucket of conversion of regular income to capital gains more concretely on the next slide, where we are looking at an example with Schedule E. The next way of tax benefit is deferral of capital gains. And I'll take a moment to talk about 1031 exchange. So 1031 exchange is a very unique concept that exists only for real estate investments. So when you have a property and you sell it, the gains from that, you can defer the capital gains by investing all the proceeds of sale into another real estate property. There's more caveats and more technicalities, which we won't go into, but it's simply if you sell a real estate property and then buy another one, then there's potential for not paying any capital gains tax on that particular transaction. That sounds great. And it is. And that's why real estate investments are favored. You cannot do the 1031 exchange with capital gains from your stock sale or a business sale. It's unique for real estate investments. So that's one way. Another way of deferring capital gains, which is applicable to other types of investments as well, are at death, any property that goes into your heirs will receive a stepped-up basis. And this is true for stocks as well as business. So that's another way of deferring capital gains. The third way is any equity that you cash out is not taxable. This is where NOI comes into play. Let's say you have been very good as an investor. You successfully increased the NOI from 100,000 to 150,000 over a period of 1 year. Now, you can go to the lender and say, like, hey, I've increased the value of this property and look at my cash flow. It's way more than when I purchased it. Guess what? The lender who's really looking at the property on its own merit will say, that's great. I can loan you more money do you want to do a refinance? So you can do a refinance, pull out the money. Now, because you can pay higher debt service, they'll give you money. And you can go invest that in some other business or another property or stock market or what have you. So any money that you get out of a cash out refinance is not taxable. And this is not limited to just once in the lifetime of your holding. You can do it every time. After 5 years, you see that it's gone up from 150 to 200,000. You can do it again. This is great. This is a great feature where you can keep borrowing as long as you're able to meet the debt obligations on the property. All right, let's make this a little more concrete with an example. I've tried to fill this Schedule E, which is basically a schedule where all your real estate, directly held real estate, shows up on in taxes. I've filled it out for the same property that we did the underwriting for. Again, this is hand-wavy. This is not meant to be taken literally. I start off with the rents received as 173,000, which is what they had claimed. And then I've gone ahead and filled out all these expenses. The first thing to note is that all these expenses reduce your taxable income. So out of 173, if you take off 140, your taxable income is only 32,000, right? That sounds great. But you say, I've lost so much expenses. Hang on a minute. The biggest expenses over there in that is depreciation, which is not an out-of-pocket expense. It's a phantom expense, which means that your real cash flow is 32,000 plus 58,000. So your cash flow from the property is around 90,000 per year, but you're paying taxes on 32,000. Isn't that great? That's exactly what depreciation does. Now, let's go back and look what happens if you add another unit. Presumably, you'll earn more. So this 173 is likely to go up, but your expenses will be more, and your depreciation is going to be more. So again, you are gaining the benefit of depreciation and other expenses throughout the lifetime. There is a caveat with depreciation. There is something called a depreciation recapture that you have to pay. when you sell the property, again, it's technical. I don't want to get into the weeds of it. If you sell the property before its lifespan is over, you'll have to pay a recapture, but that can be done at a lower, potentially at a lower tax rate. So this is great. And with what we've seen really is that if you are in a cash flow situation, even though you have higher cash flow, you tend to pay income tax on a lower part after the depreciation. And then when you sell this, obviously everything is capital gains, which is much more favorable. So this is a big advantage of real estate investing. Now let's look at pros and cons. Before we get into this, we have seen some pros and cons of all real estate investing in our previous webinar, the part 1. For example, we mentioned that how real estate investing can act as a hedge for a stock market because it has a low correlation, and that's great for an investor. And then a con was it's got a high barrier for entry. So all those pros and cons apply to direct real estate investing as well. So you'll want to check out that first episode to get a handle on that. But what we discuss here is unique to directly owned real estate. So the first one, the first pro is it's got a solid, predictable income stream when done right. Of course, we're talking about value add and multifamily, so that's that. The next pro is it's got massive tax benefits, including 1031 exchange, which is unique. And the next one is you're in control of your investment. So you get to decide when to sell, how much money to put in. Do you want to refinance? Do you want to put in more money and like do up the property further and charge more for rents? All that is in your control. On the con side, we have requires a lot of work and time. Yes, this is great. I'm sure you're appreciating all the benefits, but it does take a lot of work and time to get this right. And you need a dependable team. You can't just do this by yourself. You need a construction manager, you need a broker, you need a property manager, you need lots of things to get this right. And this is a big con. Of course, there are ways to, there are services who offer all this and you'll be paying for them, but you need to be able to get comfortable and, get to know the team before you start doing this. And then there's a steep learning curve. A webinar like this just, starts kind of scratching the surface, but you need to go much deeper. You need to do this yourself. You need to understand, all the variables that come into play. So it is a steep learning curve as well. So with that, let's summarize what we've learned. The first thing is, in directly owned real estate, you get to have complete responsibility and control over your investment. If this is something that you want, complete control, you have the time, you know what exactly you want to do, that's great. While there are many asset classes out there, multifamily tends to be very stable and dependable asset class to invest in. And this is what we recommend. Evaluating and underwriting deals is a critical part of an investor's job. That is the bread and butter of your job as an investor, is to evaluate deals, come up with sound business plans, and a financial model for the same. Most of the profit hinges on an investor's ability to raise the NOI. This is your job as an investor, is to increase the NOI of the property. If you're able to do this successfully over time, then everything else will fall into place because you're doing something right. You're adding value. While there are some massive tax benefits to directly owned real estate, it does require a lot of time and work from you, the investor. So with this, we've come to the end of the webinar. Thanks for attending. Thanks for listening in. Again, there's going to be part 1, which is already online. This is part 2. And then coming up in part 3, we're going to look at passive real estate investing. And these are for people who have made an informed choice. Okay, this requires a lot of work, directly owned, and I really don't want to pursue it right now. I'm much better off giving my money to somebody else and them managing the whole show. That is called passive real estate investing, where you don't get to say, you don't have control or responsibility, but you will be paying a fee for somebody else to do that. We'll be looking at that in the upcoming webinar. Again, thank you for your time. We'd love to hear from you. If you have any questions about today's webinar or real estate investing, please do contact us. I can be reached at Praveen at Empower Financial. That is Praveen at empower.financial. And if you scan the QR code, you can set up a 30-minute complimentary session with me. In general, we'd love to hear from you. Thanks again for your time. See you again in a later video.